Hi, everybody. Goodbye, August. Hello, September. Who's ready to have a great September? Especially after Labor Day and the NFP this week. Big month coming up in the market. Who's in the house? Alexander, Richard, Hugo, Ingmar. Okay, you guys are all ready. Okay, let's take a look around. It's interesting what happened in the yen yesterday, don't you think? Yeah, Richard. So I want to start with this. So I showed the difference in the weekly candles from last week compared to comparing the yen and the dollar. And this was last week's candle when the dollar, accelerated to the downside, yen held. So it's starting to look like we're going to travel up here towards this 112 level. I know it's all going to be hinging upon what kind of number we get, but it sure did not respond to a weak dollar, and this pattern looks incomplete. What would we have up here? Kind of see it on the daily. Hugo, I think, has been long yen. We're really not getting much of a pop in 10-year yields on that. And gold is holding up pretty good with a strong yen. So, the correlation isn't really giving any great impetus on yields. What I have noticed, though, is the long end of the market seems to be weaker than the short end. So yields are doing what when the long end is weaker than the front end? Anyone know? What do you call that?
Steepening. Good morning.
That's right. Good morning.
Which is good for banks.
That's right. Yeah, and the banks came off yesterday. So, it's actually without any kind of yield control by the Fed. I think that's the way they'd want it, is the back end to be weaker. This is pretty unusual today, guys. I don't know what's behind it, but that's a pretty big move, a 9-cent move in copper. We got back above the neckline, but this could be a failing rally. I mean, it's second major lower high in copper. And then oil, which has been tough for everyone, breakdown, false breakdown. Almost looks like it's kind of rolling a little bit here. And again, just like copper, right? 1, 2. So far, 2 lower highs in, what will we call these? Economically sensitive commodities. They look vulnerable to me. Hey, Ryan.
Hi, Dale.
How you doing, man? And gold doesn't look that vulnerable. I mean, when you look at even a 15-minute or 2-hour, it's kind of just like sideways, and gold looks like it has another high coming. Then maybe we'll get a correction. And silver's outperforming gold. But, when I look at the weekly on silver, maybe it was the daily. I mean, is it a bottom? It may be. I think we have to hold this 2365 for it to be for it to hold together. I think underneath it, it becomes vulnerable to testing out this. And there are probably a lot of stops under this low because this is way down here. So the silver daily still looks worse than the gold daily. Look at that. And I wouldn't chase gold. So what people do sometimes, I'm not saying it doesn't work. It's a catch-up trade, not ketchup and mustard, but catch-up. And they're thinking silver will catch up to the move in gold. It's possible, but what happens when you go to a discount store and you buy something that's cheaper than at a good store? Do you know, Stel, what happens when you go and buy, something junky at a discount store?
It's not the same quality.
Yeah, and you know what usually happens? Give it to your daughters to play with for a little while. What's going to happen?
Yeah,
It's going to
they
break.
exactly.
Breaks.
They'll break it, right? Anyway, um, everything's going to hinge on what happens Friday. It looks like to me. So why don't we start off a little differently? Bringing Ryan after you. Still anything overseas that you're seeing? I thought 1810 in the euro was important, but you know, when a market, just breaks out and it's underneath it, it means a number doesn't mean anything. I thought it meant something, and it did for a little while, but you never know if it means anything until it's tested out, and it's not a significant level.
I think Friday, Friday is going to be the test for everything once again. And until then, I don't trust any price moves, unless obviously they're major. But the thing we had this morning was we had some more data, and it's disappointing. See Chinese manufacturing PMI in contractionary levels again, 49.2, and the numbers are starting to disappoint a little bit. German retail sales were expected at slightly negative month on month, came in at minus 5.1%. So that was a big miss. And overall, it just doesn't look like the world economies are firing on all cylinders. And if you think about it, we've had 10 plus years of extreme monetary accommodative policies, and they just barely. Obviously, we had the big, big COVID thing, which screwed everything up. But still, they're trying, and they're really not showing too much promise at the moment. So, and the worrying thing is that we have inflation going up for various reasons that we've talked about so many times. So overall, it's a shaky situation. I don't envy central bankers at all, because it is a very difficult job they have to do, and it's just, I just don't see how we're going to get this boom, and economies are going to be doing great and all that, especially not with inflation rising. So it's,
and not with China being a big motor, right? A big part of the engine, and thank you. Now I know why copper's down 9 cents.
Yes.
And okay.
Yes. Somebody, Alexander wrote, concerns that China may tap down on rising commodity prices. And okay. Anyway, commodity prices have gone very fast, very far, but there's a reason for that. It's not that the market one day woke up and thought, "Hey, let's ramp up commodities." No, there's difficulties with sourcing and with all these things, and so that's going to be with us for a while.
Like Steve said, anything with intrinsic value is better than fiat. So people are buying everything.
Yeah,
right?
I mean, in the long run, that's definitely the case. The question is, the problem is the long run could be 20 years, so who's around for that long?
Yeah, like in the Weimar Republic, you could have a wheelbarrow full of, I don't know what they called them then, Reichsmarks or something, but people would dump out the currency and steal the wheelbarrow. So,
that's crazy.
Yeah.
But otherwise, it's been a quiet morning, and we had some UK PMI better than expected, European PMI a little bit worse than expected. I mean, in the grand scheme of things, nothing to write home about, and really, it's ADP today in 5 minutes.
Okay.
And payrolls on Friday.
Okay, thank you, bro.
No worries, man.
Appreciate your insight. So Stel says don't trust anything until Friday. I agree. What do you think? Ryan, you kind of sitting on your hands until the number?
Yeah, you got on yesterday talking about the news, the break in the euro, and 5 minutes later it's reversed 50 pips.
Is it me or is Ryan breaking up?
Ryan, you're really breaking up. Good morning, guys, by the way.
Hey, you're loud and clear, Blake. So Blake, why don't you just jump in here while Ryan comes out?
Yeah, let's see if Ryan can pull himself out of water, right? Good morning, everybody, and hey, Stelios, hey, Dale. Dale, I'm glad you got your charts back. That's good.
Steve was Speedy Gonzalez. He got it done. I went for a cup of coffee and it was done. He's really
awesome.
amazing.
That's great. Well, as we're waiting on Ryan to come back, just remember we have ADP non-farm coming out today. We also have ISM data. It's going to be the ISM manufacturing data. I wish we got this. Honestly, I wish we got the services data first. But you know, every time we get ISM data, we always get manufacturing first, then services. Just because I think the services employment data is a little bit more important for us in the it's important for us as more of a services economy. Anyway, needless to say, we got ISM manufacturing data that's coming up today. We have the ADP, and the dollar. I want to pull up a dollar chart really quick, and I just want to show you guys. I know if you're a ForexAnalytix, community, trader, and you're part of the ForexAnalytix community, you've seen this chart already. This is an inverted head and shoulder pattern. And the reason why it's important, kind of like that Canadian yen chart of the day yesterday.
Oh, yeah.
Same chart. I don't know, it's not the same chart, but it's same idea. Inverted head and shoulder pattern, false breakdown, right? So 618 retracement, you can see the fib level, 618 retracement, false breakdown below these lows. Now we're setting up an inverted head and shoulder pattern. If we have any strong data today, the ADP, ISM, people are going to go, oh, shoot, I don't want to be short the dollar ahead of jobs, right? Yeah. So you got to watch it. If we break above this 92.80, we're going to squeeze. That doesn't mean the dollar's going to 100 this week, but we're going to squeeze back to like 93 and some change. Look, in this market, if you can make 20 cents here and there, great. You know what I mean? This is not, I say in this market, especially at the very end of, well, not the end of August anymore, beginning of September, the end of summer, most people are on holiday right now, or the last of them are enjoying holiday. So yeah, I mean, if you can make a quick buck on a move ahead of the jobs report on Friday and the dollar above 92.80, there's your breakout point. So just keep an eye on today's data. Even though Stelios says don't trust data, you know what I say? Don't trust Greeks that live in
I didn't say don't trust data.
That's what I don't trust.
I said don't trust price moves ahead of payrolls.
I'm just harassing you. But Stelios, you are so right. I was actually talking to a friend of mine yesterday, and he's mostly an equity market trader, and he's a buddy that I've known for 30 years, basically. Let me see, how old am I? Make that 35 years. And he dabbles in the equity markets, and he's like, man, is this the most manipulated market I've ever seen? Like the market, the price does the same thing every day. And I'm like, yeah, Bernanke, Yellen, Powell, they all have the same playbook, and they've been playing with the same playbook since the financial crisis. That's the exact conversation we had yesterday. And it's funny that you mentioned all the stimulus that's been happening over the last, 10 plus years. It's same players, same playbook, same liquidity. And you're right. They're you wouldn't want to be in their position right now. Right. So.
Yeah, the problem is that the underlying problems are still the same. So the Fed chairs, whoever it is, they have to do the same thing over and over again as they are doing. But Anyway, it is what it is. We have ADP in about 40 seconds.
Did Ryan make it back?
I'm not sure. Let's
Ryan
see.
was gurgling earlier. So yeah,
so we're expecting 600,000-ish. Yes.
Yeah, and just going back to my comments regarding the Fed and what they're doing. I mean, they're just applying liquidity, and it's just keeping the markets propped up. So and you're right about like the China situation. It's like their data is starting to weaken. It's like, wow, is this all? This is could this be the end of the what's the terminology I'm looking for? Like Oh, wait, hold on. Data should be out momentarily. It looks like it could be weak. The
Good.
dollar is starting to weaken here.
I'm not seeing it yet.
I see gold spiking up. Do you guys see the data? Oh, ADP plus 374. That's weak data. Woohoo. Dollar is not going to like that at all. So actually that's, we were talking about, yeah, there's the dollar index. I don't know if it's going to, well, I mean, we could play down at these levels. I'll see what the dollar is going to do from here. I was hoping we'd get some stronger data, but the thing is, this is what I, have been talking to you guys about, is getting data that's weak, but not like weak, like, hey, we didn't lose jobs, so holy cow, the world's going to hell in a handbasket. But we got weak enough data where it's not meeting expectations, which means that the Fed is going to continue to keep the liquidity flowing. They're not going to be so excited about tapering, which will send stocks to all-time highs once again.
Blake, remember Neil Kashkari, the most dovish one of them all? What was it, a couple of weeks ago or last month, maybe after the payroll sprint? He said that I wouldn't be opposed to tapering, and he's the uber dove, but he did say if we see a few months of good employment data and all that. So these payrolls numbers really do matter. I know they always matter, but now they kind of matter a little bit more because this is what they're looking at. Inflation, we know, is high, and now it's employment that they're looking at, and this is going to be their excuse. If employment is not good enough, that's their excuse.
I 100% agree with you. If NFP comes in and it's just like, yeah, I mean, if we create 500,000 jobs, which, or, if you listen to the week ahead video, it's something that I was talking about. Like, these are the, what's a good term to use? The not too hot, not too cold, the porridge, right? Is that
lukewarm?
Yeah, lukewarm. Goldilocks data.
There you go.
Goldilocks, good data. I mean, not good enough, but it's not bad. That's what the market needs. Well, not what the market needs. They'll just continue to put a tailwind behind
the Fed
stocks.
Justify,
And the S&P will continue to grind higher on this damn wedge that we're in. I mean, we would need a blowout number to rock the boat. Either way, a blowout number where we had we created 1.2 million jobs this last month in August. Shoot, the stock market would roll over pretty aggressively, or if we had a blowout number to the downside where we lost jobs, I mean, this market would probably roll over, at least initially, but I don't know. Again, those are just my initial thoughts regarding ADP. I don't know if Ryan's back, but Steve's probably here. So good morning, Steve.
Morning.
How's it going?
Good. How have you been?
Now, I know in your opinion, the Fed's never, ever, ever going to raise rates. So how do you feel about the data?
Data is only relevant in the short term because, as you very well said, they won't raise rates because they can't raise rates because the accommodative monetary policy is needed to keep the charade going. So what we know from the Fed so far is the following: they're not considering raising rates until they've stopped quantitative easing, and there is not even a specific time horizon for starting to taper. When they do start to taper, there is absolutely no plan on how fast they're going to be tapering. So we have like 120 billion per month. They might do like 10, 20 billion tapering when they do eventually start, and then another 20, and then another 20, and this whole process might take 1 to 2 years. And until that happens, there is going to be a very serious reason for them to claim that they need to do quantitative easing once again. So if you want my prediction about what's going to happen with the Fed's balance sheet, and I think so far I have a very good track record, Stelios will testify to that, is that the Fed's balance sheet might slow down in growing after some tapering, but I don't think we're even going to see a quantitative tightening again. I think at some point we might stall temporarily before we get another leg higher. And I don't think this is a process that's going to be unwound unless things completely unravel, and then it's a totally different ball game.
All right. Well, thanks for your input, Steve. And the thing is I think Stelios pointed out a little earlier, the central bankers are trapped. They are, and and
they
who
built
knows?
their own trap over time.
Yeah, well, they absolutely did. And I guess the question is, how long do you keep the music playing? So looking at a few setups here really quick as far as currencies go, the dollar yen, you'll notice we hit like this, what I would consider triangle resistance. And the reason why I point this out is because if you guys have been playing the yen pairs to the long side, you got to be a little careful with the dollar yen, really rejecting up here. I've been playing the yen pairs to the long side, the euro yen, nice little breakout. We discussed this at length yesterday on the ForexAnalytix private webinars. We had, euro yen, Aussie yen, moving higher here, breaking, descending trend lines. We were looking at the New Zealand yen when it was down here at the 77 level, testing and possibly breaking 78, but we are rejecting that right now. And the Canadian yen, which was the edge chart of the day yesterday, which is free for those of you guys that read the blog. We're talking about an inverted head and shoulder pattern, and it is actually breaking out to the upside. So this all coincides with, risk assets just continuing to move higher. And the reason why I point that out is because stocks are, we're right off of our all-time highs again. And this data that we just got is going to, continue to boost risk assets. And I mean, look at cryptocurrencies. Here's Bitcoin. Bitcoin is holding well. I mean, AB equals CD. It's holding up with risk asset, excuse me. It's not pulling back. And I would have thought that Bitcoin would have pulled back by now, but no, when you have an everything rally, Bitcoin, Ethereum.
And Ethereum's outperforming.
Oh, Ethereum's outperforming. We're well above the 618. We broke out of this wedge. You can see here, this is it's hard to see, but that was the breakout point above the 618 retracement yesterday. Ethereum's breaking higher. I mean, you got the everything rally. I think the only thing we need right now, Dale, is we need gold to start playing catch up. I mean, this is, because Dale and Jim have known each other for I don't know how many years, Dale.
Since the
dinosaur age,
20s,
I think.
yeah.
Right?
Since 29, yeah.
since the 1900s, I think. Anyway, I know I'm joking, obviously, but Jim is great. I do interviews with him on Fridays because he's great to get kind of a wrap up for the week, right?
Yeah,
and he's
great any day.
He is. He's a genuinely just a really, really nice guy, and but he's great as far as his technical prowess, and he's been looking for a break, daily close above this 1840 level in gold. And frankly, the 618 retracement comes in at 1825. So I think this level right here is going to be really big for the gold market, and if gold can finally get above that, maybe that will confirm that the dollar is going to, take another beating. But I don't think gold's going to make the move. Gold's going to make a move until after the jobs report, the actual jobs report on Friday. I think that's when precious metals are going to do their thing. So, Steve, Stelios, well, I don't know if Ryan popped in yet. Did Ryan ever make his way back?
He went to fill up his tanks.
Because he was gargling water.
Yeah.
Because he was underwater. Yeah, it sounded like, that's the worst when you have horrible internet, or you're in a bad internet place at that point. But Steve, Stelios, what else do you guys have on the radar that you're seeing here?
USD yen.
Okay, so I'll go back to the USD yen, and we were just talking about. Well, here let's go over to. We're at the triangle resistance, and rejected it overnight at the 78% retracement. And matter of fact, if you guys are harmonic pattern guys, like go talk to Andre first and foremost. You could probably do this.
Yeah, I think that's the most interesting FX pair at the moment, because it will take with it, several other pairs, which seem to me like they want to continue higher. We talked about the yen pairs last week on the morning edge, and the vast majority of them seem to have been in corrective pullbacks. So, I'm monitoring USD yen, because once that goes, I think that everything goes with it.
Well, which way do you think it's going? Do you think it's going to go lower because you're a dollar bear, or do you think it's going to go higher because risk assets are going higher and yields are moving higher? And we haven't even talked about yields. I
think it looks more
maybe
likely
Stelios
that
will have something to say there. So what do you think, Steve?
I think it's more likely it's going to break higher.
Yeah. Okay. So I'm in the camp with you. As I don't know if you just heard, I was talking about the Euro yen, Aussie yen, New Zealand yen. I mean, they all look like they want to go higher as well. So so the dollar yen, I guess, you're probably looking at the same thing, and move above like 110.50. Really puts this ascending channel, you can see it more longer term, I guess, puts us up towards that 111, 112 area once again. So now, speaking of which, so we just got a couple minutes. Stelios, we haven't talked about yields. How do you feel about the bond market right now?
I want to sell bonds, but not yet. I think we're going to get if we get let's say mediocre jobs report on Friday, then I think yields probably have another little push to the downside, and that's where I'm going to be looking to sell, especially bonds. I want to sell, but
I was going to say. So one of the things that actually caught me off guard and by surprise. This is one thing that I was not expecting. I was looking at the German bonds, and 2 days ago, we had this. Well, you can look at Monday. We had this really nice recovery. I'm like, oh, here we go. We're gonna, bonds are gonna head higher. Yields are gonna move back down again. That's what I was thinking. And then yesterday, the floor fell out of the boons, and yields ripped, and I was like, what? I didn't get it. I didn't understand why that happened.
No, but we had the CPI print 3% yesterday. That was the big thing that moved them. We're expecting 2.2, I think, and we got Eurozone CPI 3%. So people are realizing that inflation is going high in Eurozone as well. I still think we're going to get some kind of a trigger for yields to go a little bit lower and sell into them, but we may have missed the move, but I'm still hopeful.
All right. Well, guys, Dale's got a interview here in just a moment. Dale, I want to make sure.
He got in now, Blake, but I just wanted to make you aware of that some people are having some issues.
People are struggling here with the webinar links. Guys, if you ever the best way to watch these webinars are going to be through the Zoom link, because you can interact with us that way. That's the best way. Or but if you ever need a backup, you can go to YouTube and watch us on YouTube live as well. The problem is if I'm here talking, or one of us are here talking, we're not going to be able to address the comments that are coming across YouTube. So and then some people use Periscope and watch us on Twitter, and but there are other ways of watching us rather than Zoom. The best way is to be on the Zoom which again is free for you guys, but to be on that, so this way you can interact with us if you have any questions or there's something that you want us to address immediately. So before I let you go, Dale, I just want to say, if you guys haven't visited our webinar sponsors, make sure you visit Forest Park FX. You could also go to Pepperstone Securities. But Forest Park FX actually has a lot of different brokers you can choose from. If you're in the U.S. Or outside the U.S., make sure you just click on where it says open account here, and they'll take you over to the Forest Park website. I'm not going to do that right at this moment in time, but you can get to them on Skype or email them directly. They manage both of those methods of communication. So make sure you get in touch with them and tell them that you came through ForexAnalytix. We'd appreciate that because they're the ones that make this possible. So Dale, have a great interview.
Thank
Steve,
you, Blake.
Stelios. Ryan said he lost audio. Not too sure what happened, but he'll be back with us tomorrow. So you guys have a great one, and we'll see the ForexAnalytix subscribers. We'll see you guys in 45 minutes on the Morning Edge webinar.
Indeed. Bye-bye.
Good hunting today.
Thanks,
Blake,
everybody.
Stel and Steve, the best team on the internet, the best webinar, free or paid. The best of everything happens here. And now we have Stephen Clapham. What else can you ask for? Stephen, welcome back. How are you, buddy?
I'm very well, Blake. And how are you doing?
I dream of a life like Blake's, but I'm Dale.
Oh, I'm talking to Dale. Sorry, I said Blake.
That's okay.
How are you doing?
It's a compliment. I'm doing okay, partner. I'm really interested in what you're going to present today. And are you going to share your screen, or are we just going to talk about things?
I was just going to do. We had a general conversation last time. I was going to do the same thing because I thought it was quite fun. I can tell you, I've just moved office this morning, and I was slightly panicking because the technology to make it all work is a bit okay, and I got it all working, and then I realized I couldn't find the link to log on. But thank you for sending that through. So last time we were talking about inflation, and when I just logged on there, you guys were talking about inflation, and it's quite interesting. You're seeing inflation pick up in Europe, and we've seen it pick up in the United States, and the Europeans are terribly frightened about it. But I think the inflation figures are massively, massively understated. I think my experience is that inflation is running close to 10%.
Wow. Okay. Yeah. You mean the real inflation rate of things that people need to live?
Yeah.
Like housing and healthcare and food and gasoline and everything, right?
Yeah.
Not flat screen TVs and laptops.
Well, exactly. I mean, this is I think the real inflation is the inflation that hits the pound in your pocket, used to be the expression over here, that hits the dollars in your wallet, right? And I mean, obviously, my big expenditures are on things like healthcare, right, and the kids' education and those sort of things, and they are going through the roof. But I'll tell you, in the UK, we have got a massive problem with supply. So we have
so you're getting shortages now, Stephen, and things that you were easy and convenient to get that you can't get anymore.
So we had some warm weather, which is quite unusual for us, and I could not get a bottle of water, a bottle of Evian, or a bottle of just the supermarket own label water. Yeah, there are 3-4 supermarkets within 5 minutes walk, 10 minutes walk of my office, maybe 5 supermarkets. Yeah. For a whole week, you could not buy a 2-liter, 1.5 liter bottle of water.
Yeah.
You know, I mean, I have never experienced anything like this.
You know what? The world, most of us in our lifetime were so, should I say, spoiled or just used to having everything at our fingertips and not having shortages. I mean, you know, in the US, you probably have to go back to World War II when people would turn in their tires and metal and everything for the war effort, and there were gas ration coupons, and so, you know, most of our generation, we don't remember that. You know, I was a baby boomer, not around during that time, but yeah, there've been isolated things with, like, you know, OPEC embargo and oil embargo that, you know, oils and everything. So, you know, you had an inflation problem there, but this is supply chain. You know, just as needed type of, you know, it's not like people really store a lot of inventory. Just in time, that's what it's called. So just in time type of management of inventory has turned into out of time delivery. So I think that's just the start of it. I mean, they talk about supply chain issues being resolved. What's going to resolve them? Like semiconductor. I know you don't drink semiconductors, but you know that was the first thing that the world noticed.
Well,
So how does that fit in with, you know, what you do? It has to go into your formula now, right? When you're looking at equities.
yeah, I mean, I think, you know, this is really, really important, because when we've had periods of high inflation in the past, we've always seen a lower multiple on the stock market. So inflation gets above 4%, the stock market's always been derated. Now, it may not happen like that this time, Dale, because if we think back, when we had high inflation, we were always concerned about higher interest rates. And that may have been the motivation for the derating of the market. And we won't get that same hit this time round. But, you know, I'm very concerned that people, you know, saying, oh, it's just supply shortages, just temporary, all correct. I have to tell you, in the United Kingdom, we are short of 100,000 lorry drivers, truck drivers.
Yeah, that too,
And
everywhere.
You know, if you don't have any truck drivers, you can't deliver your product. And 100,000, I mean, that is a huge number when you're looking at a population of just over 60 million. I mean, you know, we're between a fifth and a sixth the size of the United States. So that's the equivalent of the US being short of 500,000 truck drivers. In actual fact, it's equivalent to the US being short of more than that, because we do a lot of our deliveries by rail. So trucks are a smaller component of our total logistics chain. So imagine in the US, if you were short of 600,000 or 700,000 truck drivers, that would be.
We are having problems.
Yeah.
Maybe not to the same extent. Let me ask you this, Stephen, because you have maybe another issue on top of what the rest of the world have an issue. Is Brexit also part of it? The shortages that you have there in the UK?
Absolutely. You know,
Okay.
we didn't have time to prepare, and the government has done a terrible job of setting all this up. And of course, the consequences of Brexit, you know, the paperwork. I was talking to somebody, small business, the other day, and they're actually giving up because they import a lot of product from Europe, and the paperwork. There's so much paperwork involved. They decided, you know what, it's just not worth our while importing this stuff, and they're closing their business because they just can't cope. Now that's probably, you know, a slightly extreme example, but we're seeing this everywhere, that there's more regulation, there's more paperwork, and there's not enough people. And Brexit is going to cause us a huge problem for the next several years. I mean, there's no way around that. And how that manifests itself, well, you know, it probably manifests itself in inflation, because if you don't have people, you know, you've got to pay them more. So, you know, that this whole inflation thing has been occupying my mind for quite some time. And the other thing that we should talk about is the whole issue of China and what's happening with the government there, because
I'd love to, because, you know, Stephen, and I want your thoughts on this, because remember the Great Recession. China really didn't get hit as hard by, you know, the derivative implosion that we had in the developing markets, developing world. They got hit, but they were really one of the only engines of growth. And back then, a lot of analysts would talk about how China could lead us out of the Great Recession, which it did. So if China is, we're getting recessionary, whether it's deliberate or it's happening, they say they're tamping down. But either way, if China is going to have economic issues and a slowing economy, like the numbers that are coming out, plus what they're doing regulation-wise, well, it's not regulations, just draconian things on Chinese stocks. Could China drag the world down, just like they lifted the world up?
well, I mean, they've certainly already dragged their own stocks down. I mean, when you look at the action, particularly in China tech, it's been pretty severe. And you know, if you compare China tech to US tech, it's been looking pretty horrible. And George Soros wrote a comment column for the Financial Times the other day, and he basically said, you know, President Xi does not understand how markets operate, and as a consequence, the sell-off was allowed to go too far. And he was saying that, you know, Xi is a communist. You know, he wants to go back to Mao Zedong days. Now, I think that's probably far too draconian a view, but it's very clear that he doesn't really care too much about US investors. You know, what do you do if you're, I mean, leave aside, you know, us trading in the market, because we can probably trade into some of these stocks and take advantage of a balance and trade out. But say you're a big US institution with a big holding in Alibaba, what do you do? It's a very difficult situation to analyze, because you basically, to analyze this situation, you've got to get inside Xi's head. And who the hell knows what he's thinking?
Oh, I looked into his eyes and I could see his soul.
Yeah. Well, you know,
yeah, one of those moments.
You might as well, you know, employ a fortune teller or a tarot card reader, you know?
Yeah.
Because, you know, somebody like me looking at numbers isn't gonna be of any help, right?
So your research, Stephen, and you know, I've been showing, I don't know if you know this, I've been showing your website, and you know, all the books that you've written, you're prolific. You know, I know I'm not a paid subscriber, but I'm giving you some visibility. What are you telling people in this environment? Markets are making new all-time highs. You don't think that despite the inflation problem, you're not alone. I've talked to other people who and you know, analysts and economists that say, you know, a lot of people think that we're near the low in real rates, not nominal, but real, at -1 or so. And one of the guys said that in World War II, we actually went negative real rates by about 14-15%. And that's probably, you know, 1%, -1% is not the low in negative real rates. So are you in that camp? And are stocks really a good inflation hedge? Perhaps that's why they're heading higher. I don't know why the FANG stocks would like inflation. Do you? Been a lot of rotation into the mega cap tech.
Well, this is an interesting question, because I was having a discussion about this.
That's what I do.
And I'm going to just refer to two people. I'm going to talk about Russell Napier's views in a minute, because he's a very interesting economist. But
yes, I've heard of him.
Since I was last on your show, I've started a podcast. So for your listeners,
yeah, I saw that.
So with the Behind the Balance Sheet podcast, our first guest was Brent Hoberman, who's a venture capitalist, and John Armitage. Now, John Armitage, none of your listeners will ever have heard of him, but he is a genius, right? I have got money invested with John because he's one of the best investors anywhere. He's run his hedge fund for 27 years, and he wouldn't let me quote his compliance department wouldn't let me quote his record, but I can tell you that his record, and this is not a small fund, right? He manages $27.5 billion. And it's one of the largest hedge funds in the world. And he's got the longest and probably the most successful track record, although people haven't heard of him. And what was very interesting was he and I are of a similar vintage. And he was saying that one of the things that is very difficult for people like us is we were brought up at a time when, you know, a PE of 20 was a rich valuation. And EV to revenue of 20 times is something that's very difficult for us to cope with and to think about. And you're seeing this, you know, Zoom, I think, is on 24 times revenues last time I looked. And,
Yeah, it took a hit. It took a hit. I think yesterday. Was that earnings or earnings?
Yeah, I mean, its growth is slowing. I mean, big surprise, right? Its growth would be slowing. Well, guess what? We're all going back to work. And
people are getting burned out with doing everything on Zoom.
Absolutely. I mean, people hate it. I did my.
Well, we're on Zoom right now.
Well, we're on Zoom right now.
Well, don't say people hate it because they're enjoying themselves right now with us.
But
we're making their whole day right now in about 30 minutes.
Dale, you produce such a quality show that people would
they go on Zoom. Yeah. Okay. Well, Zoom is. They called me to make sure I keep using it. So, anyway, so is Brent is what Brent is saying? Basically that, you know, maybe we could go to the 40s on PE and things like that in this new abnormal.
Well, so I just wanted to tell you that Russell Napier, you may not have heard of him, but
I have. I haven't interviewed him, but I do. I'm aware of the name. Yeah.
Yeah. I mean, he's a genius, right? And funny
he's
enough,
always bullish, right? There's always a bull market somewhere for that guy, right?
He is bullish for the short term, but he's very bearish medium term to long term, because he says, and this is back to the war, he says the only parallel that you can paint is the period post the Second World War. And he said that governments are going to engage in financial repression, and they're going to keep interest rates down, and they're going to force investors to buy bonds.
Bonds, not stocks?
Bonds, not stocks.
How do they force people after a prolific bull market in equities to run out and buy bonds with like a 10-year note with a 1.3 yield?
I mean, they have done this in the past. I mean, in the 1970s, there was, in the United States, there was an Office of Price Control. And in the 40s and 50s, for example, in France, you couldn't raise money on the equity market without permission from the government. And he says we're going back to that sort of environment in which the governments will dictate the flow of money. Because he said, look at the debts. Look at the debts governments have got. How else do they get out of this other than engineering low rates and inflating the debt away? And he's got a very negative perspective on the long term. And he says that the institutions won't be allowed to buy equities. Now, I know this is a very, very radical view, and I'm not sure that I completely...
That's the end of our business, isn't it?
Well, I don't think it'll be the end of our business, because there'll still be stocks there. But, you know, what he's saying is that although we've got very low rates and you would imagine that PEs could go to the moon, that probably isn't what's going to happen, because who will buy a government bond in that environment? And when people stop wanting to own bonds, the government will have to force you to own bonds. Now, we seem to be in an environment in which people are still happy holding treasuries. They seem to be happy holding even German bunds, where you have to pay the German government for the privilege of lending the money, which is something I can't even begin to understand.
Why are they, Stephen? Why are they okay with doing that?
Well, I think it's these, what else do you do? I think that's
you buy anything. You buy you buy water.
Well, people have been buying all sorts of stuff, right?
Yeah, SPACs, NFTs, crypto.
Yeah.
Maybe that's what really, even though crypto, you already have to say, has been in, a tremendous bull market, maybe that even adds more jet fuel. If the government's going to force you how to invest, you have a view that perhaps crypto is where flight capital will go to if they don't want to be forced to buy a bond?
Well, I think the problem I've got, and this is a very extreme scenario. I don't, this isn't my central case, but I think it's interesting for discussion. And, the problem, if you take these extreme situations, is that you won't be allowed to own crypto. And that's, well, if you think about a situation in which interest rates are heavily negative, and so that, the yield in treasuries is a negative yield, significantly negative, what would people do? They wouldn't want to own bonds, and they would start buying cryptocurrency. What would the government do? The government would stop them, right?
Yeah, well, China led the way, right?
Yeah. Now, obviously,
do you think there are any Chinese that still own crypto?
Oh, I'm sure there are.
Yeah,
I'm sure there's lots of them.
Okay.
The Chinese don't trust the Chinese government. Chinese capitalists don't trust the Chinese government and quite rightly, yeah. So I think there's a risk with crypto, and that.
How about gold? There is a history of gold confiscation in the U.S.
Yeah, well, I think gold to me is a more durable and safer bet. It's obviously, first of all, it hasn't gone up nearly as much as crypto.
Right.
Second of all, it's got a long history. And third of all, if people still will want gold jewelry, right? So there is a use for it. Obviously, if you weren't able to trade it, it probably wouldn't be at the price it is.
Well, there's some industrial use too. So are you recommending when you do your work and look at balance sheets, which is your wheelhouse, any of the miners that look attractive to you in this inflationary environment?
Well, it's hard to find a gold miner that doesn't look attractive, to be honest. I mean, the
that's interesting.
Well, I mean, look, this is an asymmetric bet, right? You don't need much on the gold price for these stocks, the earnings to go through the roof. Right. And, lots of them have had very significant escalations in their cost base. So it just makes them much more geared to the price, because obviously the higher your costs, then the more benefit you get from the extra $100 on the gold price. So, I think that the gold miners are still attractive. And
okay,
and as I said last time,
I agree.
As I said last time I was on, the other place I think is attractive is the UK, because we're seeing all
the FTSE.
Yeah, I mean there's a huge amount of value. We've had a bid for William Morrison, which is probably the number 4 supermarket chain in the UK. The supermarkets have been out of fashion for probably nearly 10 years now, because we've had these low-cost discounters, Aldi and Lidl from Germany, come in and take market share, and they've been growing very aggressively. And the problem that with Aldi and Lidl is that their prices are, 30-40% cheaper than the major supermarket chains. They're all private label stuff. So, you go into an Aldi or you go into a Lidl and you don't see any brand names you recognize, but it's very cheap, and it's been a very strong product in its home market in Germany, and they've been growing and growing. As a consequence of that, Sainsbury's, I looked at Sainsbury's probably 5 years ago, and the Sainsbury's market cap was below the value of its freehold property. And I looked at it, I said, well, this is daft, right? This is crazy. And this has led to the bid for Morrison's, because Morrison's owns 87% of its stores. So it's got a huge property backing. And it also owns a whole swathe of distribution warehouses. And distribution warehouses, the valuation, the yields on those have fallen through the floor because everybody wants distribution warehouses. So these private equity guys have come in and looked at Morrison's. They said, you know what? We can sell off the property, we can sell off the warehouses, lease everything, and we'll pay for the bid. Now, we won't make as much money, but we'll still make some money. And so, there's still these sort of weird pockets of value in the UK where there's,
one of our attendees is saying that German supermarkets are here in America as well, at least in the Northeast, which is a new trend. So looks like they're, also doing it here in the States.
Yeah, and they will cause a huge amount of problems to the incumbents. I think people have underestimated these guys are incredibly patient, incredibly smart, and they've got, their products appeal to consumers, particularly the lower paid, because, if you're trying to feed your family and you're short of money, you don't care what it says on the outside of the packet.
No.
And the products are good quality.
Okay.
So I think they'll cause the US supermarket chains a lot of trouble.
Yeah, Aldi, we're getting, you struck a nerve with some people because we're getting some action here from attendees. They're saying Aldi is 30% lower price than average grocery store, and Aldi is huge in Australia. And then when it comes to the German supermarkets, better prices, decent product. So exactly what you're saying.
Yeah, and they're not. To be honest, Dale, it's not where my wife wants to shop. One of them's open in our neighborhood, and my wife won't shop there because it's not a very nice ambiance. When you go around, because what they do is they display stuff in cardboard boxes. Because it's cheap and quick. And
maybe they could light a few candles and play some music. Change it for her.
Aromatherapy.
Anyway, at least she's shopping for you. Okay, while you're thinking about all these things, she's out there shopping, and great to have a good partner, isn't it?
Well, in fact, my wife rarely shops in person because we do, most of our shopping is done online.
Yeah.
So we've got this terrific online supermarket, which is quoted, Ocado. And it's been a terrific stock. And my wife is very upset with me because I didn't buy the stock. I looked at it for a long time and I just couldn't get my head around the numbers. And it was one of my most stupid mistakes. I didn't buy it. But
I'll let it go. You know what the most important word is in our industry and in life? Next.
Yeah, I agree.
Right, buddy? So I just did a little mentoring for you, not that you need it, but I used to spend a lot of time self-flagellating. And
I think a certain amount of self-flagellation is quite a positive thing, because, you remind yourself that you're not as smart as you think you are.
Yeah.
And
I-
I think that's a very good discipline, because when you think, oh man, this is the next big thing, you think, oh, okay, well, look what I missed, or look what I got wrong. And so I like to remember my mistakes. And, you know, to be fair, there are so many of them that it's hard to forget them.
you could write a book.
Yeah, well, indeed.
All my bit, and you learn the most from your mistakes anyway.
Yeah,
don't you?
Well, I think the important thing is to remember your mistakes and try and learn from them. And we're doing a course in October, November time. We're going to do a new course. You know, I do a lot of training courses, and we're going to be doing a new online cohort-based course where for 6, 7, 8 weeks, people will do, you know, sign up two evenings a week, my time, 2 mornings a week, Pacific time, lunchtime in New York. And we'll do 90-minute sessions. And it's about how to improve your behavior when you're investing. Because
it's all in our heads, isn't it?
Yeah. And I've teamed up with a guy who is an executive coach, and he's very good at getting you to change your habits. And it's all about, okay, let's look at what mistakes we've made. Let's look at why we make mistakes, and let's figure out how we can do better next time. And I'm quite excited about it, because this is something that I have grappled with for many, many years, that just trying to improve my emotional ability to cope with the stress of the markets and not react and keep calm.
You're not alone, Stephen. And you know what? Speaking about mistakes, here's what I say. It's never a mistake to spend 30 minutes with you and have a conversation and hear what you're thinking. And I really want to thank you for being generous, having a giving spirit, and spending some time edifying the F.A.C.E community.
Hey, it's such fun. I hope you're going to invite me back soon.
Do you want my bank wire number? Just kidding.
You're such a comedian. It's such a pleasure. Thank you so much for having me on. I really enjoy it.
Yeah, my boss says they're all dad jokes. So, you know, dad. Anyway, corny. So I really appreciate it talking to you again, Stephen. Thank you so much. And coming from you, talking about how rates are going to go, and that governments may really become draconian down the line. Very interesting conversation. And you will have an invitation. I'll touch base with you on Twitter to return. And in the meantime, good luck with everything that's on the table for you. Positions, subscribers, mentees. Wish you rooting for you and everything you do, Stephen.
Thank you so much, Dale. Take care.
All right, so that's a wrap. And here's Stephen's website, behindthebalancesheet.com. You could find him, and you could find him on Twitter at Steve Clapham. Here it is, right here. Okay. And that's a wrap, everyone. Thank you for hanging out with us. Appreciate it very much. And look forward to, seeing you guys tomorrow. S&Ps are starting to fade a little bit here. Unable to make a new high. NASDAQ still outperforming. And you could get some updates on what's going on here with the dollar selling off pretty dramatically. What a turn in the yen and the dollar today. So very whippy markets. Welcome September. I'm glad you're here. You could join the crew in 12 minutes, everyone, on the morning edge. And you have to be sharp to be on the morning edge crew. It's an edge that we all walk as traders. So don't just count your pips, count your blessings, everyone. You're welcome, Hannah, Alexander, Ingmar, you're welcome. We'll see you guys tomorrow. Anthony, thank you very much, and adios. See you tomorrow.